Welcome everybody to our meetup.
Okay, cool.
So tonight we're gonna have some special guests here. So again, we are very appreciative of everybody coming over here from far and from close by. We have great people here today. I personally work with Sean here quite a bit of times.
Great turnout. I wasn't sure what to expect. My name is Sean Hunt. I am the area manager for CMG Home Loans. So locally, we have an office right on Main Street in Salisbury, as well as 79th Street in Ocean City. I've been doing this now for about 18 years. I'm from the shore. Went to Bennett, went to Salisbury University, so I grew up around here. So excited to speak to you about some different things we have and opportunities we can to help you as well. So I wanted to start. There's no script here today, right? So I didn't prepare a script. I'm going totally off the cuff. So if you want me to talk about something specific, ask away at it as well. But I wanted to start out with a little bit of a market update for this craziness that we're all seeing right now. To start, interest rates have gone up. We all know what's going on there. It's very common to have an interest rate in the 7s right now on a 30-year fixed. At CMG, we do have a special program where if you have a 700 credit score, we can price an investment or a second home much like a primary home. So we give you a discount on that interest rate, more so than what you might see with a conventional, Fannie, Freddie normal loan. Okay, so that's helping out a little bit there. Typically, when you're doing an investment, a lot of people are like, well, what's going to happen with my rates as we go? Well, you're looking at cash flow. So the interest rates, yes, while they're very important, we'd like them to come down, but you can still make cash flow, even with a higher interest rate. I listened to an economist today really predict, with all the negativity of what rates are going to do, and Fannie and Freddie forecasting that rates still may increase a little bit more, all the signs are showing that rates are going to start to settle down the second half of this year. Okay, it's a projection, just like the weather. They could call for it to be sunny tomorrow. I don't know. I don't think it's going to be, but we'll see what happens. But with that projection, the media's coming out there and saying rates are going to be high. Rates are going to be high. We're going to see dips. In this market trend, we see rates kind of settle down for 2 to 3 weeks. We see rates spike up for 2 to 3 weeks, depending on what's going on in the world. So that's something we're just having to deal with, with that. With dealing with us, we're always updating you on what the interest rates are doing, for your typical transaction. A normal transaction for an investor requires 15% down, okay? And that's your normal Fannie Mae, Freddie Mac, 30-year fixed, 15-year fixed mortgage, okay? So the minimum is going to be 15% down. With 15%, you do have PMI. So a lot of investors don't like that. So that's why you hear a lot of investors just do the normal 20% down to avoid PMI, okay? Guidelines are shifting a little bit. They're becoming more strict on what they call your debt to income ratios right now, okay? Normally, I'd say 45% is where they want your debt to income ratio. If you're a strong file, they will let you go up to 50%, okay? But from what we're seeing in the guidelines, they're not announcing this, but they're becoming a little tighter on those things. What other things strengthen your file? Do you have reserves? Extra money in the bank, that you can say, okay, I can cover the cost of this mortgage for the next couple months. Typically, they want 6 months reserves in the bank. Now that could be in a checking or savings account. It could be in an IRA. It could be your 401k. There's ways that we can look at those reserves, for you if you don't have them liquid per se right now, okay? But these are your normal, if I say vanilla, fit into the box investment programs. But then you're starting to hear, well, there's some unique programs coming out too, okay? One of the things with Fannie and Freddie, you can only have 10 finance properties in your personal name, okay? So that as you're growing your portfolio, what happens when you get 10? Well, you can either start an LLC, roll those properties into an LLC. Well, now they're under the LLC, they're not under you personally, okay? So we could talk about that strategy. There are certain investors that we can look at and broker out to that will allow you to have more than 10 finance properties, okay? What comes with that? There's different criteria. It depends on the investor, what they require, how many reserves they want, what's their interest rate. So that all changes depending on how your situation is set up. And that's where a lender like myself will kind of break it down for you and really strategize with you on what we can do to make sure, you're getting the best bang for your buck on that. Who here has heard of DSCR loans or DCSR loans? I always mess it up. Okay. Popular topic right now, debt service coverage ratio, okay? Basically, it's very similar to a no-doc loan. With those programs, they're looking uniquely at the property you're buying. There's no employment income, there's no income verification. They look at credit, and then they look at the profitability on your rental property that you're buying. So if you have a $1,000 mortgage payment and we can verify through an appraisal that the market rent's $2,000, they divide that out, you're profitable. That's what they're going off of. That's it. I argued with our product team. I was like, there's no way it's that easy. He's like, it is that easy. Okay? The negative to it, interest rates are higher. You know, for them taking the risk on that and saying, hey, we're going to limit what you have to do to qualify on this, there's a good chance the interest rates might be in the 8s to 11% range, depending on your credit score and things like that. As we talked to somebody about earlier, if your property still cash flows, then it's a great thing. Because typically with going back to the normal loans, we have to get your tax returns, we have to get your income documentations. I had a realtor come to me this year and said, I'm really taking a hit on my tax returns this year. I want to buy this investment property, but I know I'm not going to qualify based on my tax returns. He's like, what about this, DCSR program? So we started looking at it, and he qualified based on it because we just looked at that property. I didn't have to look at his tax returns at all, document him. I didn't have to worry about his debt ratio or anything like that because of this hit he took. So it's just a unique way that we can look to qualify you if we're worried about financially how we might qualify under the normal standards. Okay? Good. Typically it's 20%. Yes, typically 20% on those. Now, same thing, if you're putting 20% down, your rate might be a little higher than if you put 30% down, on that program. If your credit scores, a lot of them with investments, they want you to have a 680 credit score or above, on that. If for some reason your credit score is lower than a 680, we have a tool where we can look at your credit and say, hey, if you pay this down, we can bump your credit score back up. There's different strategies to that as well. We're not credit repair by any means, but there are tools we have that we can say, okay, we need to bump you up. What can we do? And a lot of times it's as simple as paying down a credit card, for that. Good.
The income of the property to the mortgage ratio.
Yeah.
Is it set or like is it
No,
variable?
typically your rate is based on how much of a profit you're making. So as long as you're positive to anything, you're good.
Factoring all costs in that?
No, pay our principal, interest, taxes, and insurance,
That's it?
and HOA or condo fees if you had those.
Property management or any other?
So far, the one I did not. Now, this is what we're seeing with these brokers and these programs. Guidelines are changing quicker now in today's market. It's all based on risk, okay? Everything's risk. The investors behind the scenes control it. So if they feel like, okay, let's just take a second home. Generally, your second home is 10% down. Well, they could say, well, our investor doesn't like that. We want it to be 15% down. They can make that guideline change. It's still 10% down, but everything's risk associated right now because they have the same concerns we do behind the scenes. What are property values going to do over the next couple years? Are we going to see a decline? A lot of reports this year said property values are going to start to decline. I think that's totally false. Basic economics is supply and demand. The supply is low, demand is high on things right now. So that's going to keep pushing these values a little bit. I know as investors, now you want to get the stuff at a lower cost, obviously, but that's kind of dictating the market a little bit. And really, I think we're going to have an inventory shortage on things for a number of years to come, for that. People aren't selling their houses as quickly because they're locked into a 2 to 3% interest rate. So why would they want a 7% unless they have to or really, really want to on that? But for investors, it's different. It's all about cash flow, for that. So yeah, same to your question. There's not a lot of expenses taken into it. It's just that market rent, which we get by the appraisal. You can't say I'm going to charge $2,500. You can, and we can document that if you have a lease already. But they're going to go by what the appraiser says for that market rent study on the appraisal. Go ahead, go for it.
For those types of loans, with a lot of the traditional type loans, where you get your down payment has to be your own personal down payment.
Yep.
For those types of loans, it doesn't matter where you get your down payment.
They do check your assets. They want you to have your own money on those. And typically on investments, that's where like a gift doesn't come into play. It has to be your own funds on those. Now you can pull it. We've seen people pull funds from a number of places. Do you have it in your checking and savings? I know financial advisors will say don't pull it from your IRAs or portfolio because there's risk there and there's also penalties, but it depends what the penalty is. I've seen people lately pull it from their 401k because typically you can take a loan of up to 60% of your balance from your 401k with most 401k companies. You have to check with your own personal 401k, but you can take a loan against yourself and then you're paying yourself back with interest. And that's how we see a lot of these investors. That's kind of some of the things we'll throw out there to see if we can get that going, for you as well. But, if you buy a property with cash.
Right, then
You can refinance within 6 months, but you can only refinance it for what you bought it for, that value. To get a new value, or if you bought it and you got a great deal and it's worth, you bought it for 150 and it's worth 200, then you have to wait 6 months if we're doing like a cash out refinance on that, if we want the top value.
So the cash out refinance and the DSCR loans are different.
Two separate things. Yeah, two
So
separate
the
things.
DSCR loan, you don't have to hold the property for a certain amount of time before applying for that type of loan.
I would have to check on that one. I don't know that guideline. Do you know that guideline?
I do not know
Do you
that.
know that? I don't know that one.
They're pretty loose though, because they're not QM. They're not QM loans.
They're not qualified mortgages.
Yeah.
So it depends on the broker.
Okay.
Yeah, because a lot of those are not held internally. So CMG, a lot of the stuff we do is all internal. A lot of the DSCR, we have an internal one. It's more strict and the rates are higher. So we tend to broker out because the rates are better.
Okay.
So I would have to look at the specific investor. I don't want to tell you wrong
Okay.
on anything on that.
You may have said this, is it the DSCR loan, is it 30-year fixed?
It is. Now right now the plan, the ones we've talked about, nobody's planning on keeping it for 30 years. You know, when rates finally lower, or, you know, we have the assets or we have the income to do it, most people are going to try to refinance it at some point if rates do settle for that, but it's just a way to get in the door if we can at this time. Somebody? Bob Joe? Thought you had something. No, oh, go, good.
What is your ratio? It has to be equal to, your income has to be greater, equal to or greater than the payment?
On the DSCR?
Yes.
Basically, you just have to be profitable. So if you have a $1,000 payment, a mortgage payment, all in, and you're charging $1,200 in rent, you're profitable.
Okay, so that's.
So you're good. Now, your interest rate, you're not that profitable, right? We're still tight on things. So your rate might be higher based on that versus if you were renting for $2,000 and had a $1,000 payment.
Right.
So your rate's going to be better the more profitable you're going to be.
All right. If it's the reverse, which I would think many times it is, because you can't buy it and rent it and make a profit a lot of times. Is that when you go to a conventional
Correct.
underwriting?
Correct. Then you'd have to go. But if you don't qualify or you're underwater, you're not going to make money on that, or for some reason, you know, it just doesn't work out to be profitable, then we'd have to look at another avenue
Okay.
for those. They want you to be profitable right away based on payment versus rent.
So you're saying that the ratio has to be 1 or more, and then you're.
Correct. Yep.
So are you underwriting those at the same time, or does somebody come to you and say, I want to do it?
Well, yeah, so we would, in a pre-approval process, if I'm taking an application for you and we're talking about it and we know we're going to go down this road, one, that's my job. I'm going to be looking up the guidelines for the different brokers that we have to make sure we fit. Then we run the scenario to them and say, hey, here's what we have. We have a contact basically with the brokers that we talk to, and they say, okay, here's our guidelines, here's where it needs to be, here's our rate sheet, so I can present it back to you and say, this is what it looks like. And then once it comes to us, you go under contract on that home, then it will go through an underwrite, but it has to go through the broker's underwriting, which the underwriting's not hard, it's really the calculation. That's it.
When I go to underwriting, let's have it going. Does my asset already have to be stabilized, aka it's already rented out and I have a signed lease, or can I say the projected rent for this property after renovations?
Projected rent.
Projected rent?
Mm-hmm.
Okay. So I could take
Because a lot of times you're buying it, you don't have a renter in there at that time. You're
so
buying it
I
as an
have
investment.
loan funds or like a line of credit
Mhm.
or some other money to actually renovate and fix it up.
Correct. Correct.
Talking about renovating.
Yeah.
and doing a rent.
You're talking about the renovate, which we're going to touch base on in 1 second with Lewis. He's going to touch on that. So you're talking about using your own money. You're buying the property as the DSCR, renovating it with your own money, and then getting a lease down the road. Yes. Yeah, you could still use that.
Do they have like if they're buying a property that needs to be renovated, the DSCR or does it already have to
You
be
can't-
ready to go?
I apologize. I'm sorry.
You can't do the renovation with the DSCR. No.
I have an outside source for that.
Outside source.
We can't do it in house.
But the DSCR, will they allow you to say this property is going to need remodel? I don't need the funds from the DSCR, it's going to need remodel, and you can use that loan, or does it have to be
Yes.
rent ready? Okay.
Yeah.
Yes.
So since we're going on that topic, I'm going to let Lewis pop up, and he'll dig into the renovation side of things for us a little bit.
Let me ask a question for Louis.
Yeah, sure.
So is there a percentage, say, if you're 1-to-1, meaning you're renting for 1,000 and your PITI is 1,000, is it 10%? And then if you're a 1.2, it's 7% or 8%?
Correct. Yeah. The
Is
more
there a scale?
there's not a scale per se. Every broker's different on how they price them out. It's just the higher your percentage or the higher your profitability, the better the rate you're going to get. Now you're still paying 8-9%. You know, it could go up to 12-13%. You know, if depending on credit and where you're at right now. Yeah. Still dictated by credit. You know, if you're a 680, you know, obviously your rate's going to be higher than if you were a 780.
So what weighs more, the credit score or the ratio?
Credit score. Credit score still rules everything
Yep.
on that.
And you don't need DSCR for commercial?
No. I don't know anybody. I know Bob said you don't. Do you know anybody that has that type of program, commercial? No. No, I don't.
Not a typical bank. That's not a thing.
No, it is not. It's a non-QM. Yeah, certain investors. We have 2 or 3 investors that offer it. So CMG is throughout the United States. So a lot of these investors aren't even local. You know, they cover the different areas. So some people, all ours do Maryland, so we're good there. But some of them, let's just say, they might not do Pennsylvania. You know, that broker might not, and then we just go to a different broker
So,
for that.
sorry, are they funded by hedge funds or how's it funded?
It's usually regional banks that are offering them out. Yep. So this time, real quick, I'm going to transfer over to Lewis to talk to you about the renovation side of things. Think about some questions I'll come back to on that. So.
Great. Thank you. Well, he gets clapping. Huh?
I do. It's good.
So you know when you do
tell my wife that
presentations,
when I
they
get
send one good-looking guy and one smart guy. I'm the smart guy. He's a good-looking guy. I'm the smart guy. Okay, so you got pretty boy out of the way. Now we're going to learn something. So I've been in the mortgage business since 1998, which is about 24 years. My background's in construction. I've done remodeling. I've built houses. So I know both sides of renovation and investment. And my job at CMG is I'm a renovation specialist. So anytime anybody needs a renovation loan, I work with Sean and we work together and get it done because I know all the little idiosyncrasies of those loans, which can be tough. From an investor standpoint, it's sort of simple, but I'm going to go through some things. I'll answer your questions. But the thing I want you to walk away here with today is that no matter what you have, call us and see if we can figure it out. Because we have some sources within CMG, we have some brokers, and I have some personal relationships. So if you need something done, at least give us a chance and run the scenario by us so we know what's going on. Because there may be a way that we can help you, even if we're referring you out to somebody, hoping maybe you'll come back to us when it's time to refinance or whatever, okay? So the simple thing is we have a renovation loan that's a Fannie Freddie product, and it can be done for investors, and it's, as Sean said, it's 15% down, but most people do 20. And we will lend you the money to buy the house, and we'll lend you the money to do the renovation in a single loan. Where a lot of investors have a challenge with this is that we require you use a licensed contractor. And it can be somebody you know or a family member, but they have to have a license and they have to have insurance in order to do the construction work. And we pay them withdrawals as the work goes along, okay? So if you're new to this and you want to try one, this is a great way to start because your rate's not going to be crazy. We're going to have somebody to make sure everything's going to go smooth, that watches over the project, a consultant, those types of things, and you can do that sort of as your first loan, okay? We also have that product with Freddie, where if you have student loans, Freddie has a better calculation on student loan repayment, so we can help your ratios on that. So one's called Home Choice, one's called Home Style. You don't have to know that. All you have to know is to call us, and then we'll walk you through the pattern, okay? What a lot of investors are doing, especially when they're getting started, is they're buying a 2 to 4 unit property and utilizing the rent of the vacant units to help them qualify. You have to live in one unit, okay? So you would live in one unit. You could rent the other 2 or 3 units, depending on how many you had, and it's a way for you to get in with 3.5% down payment. The credit score is 620. Your rate's going to be not terrible, and you can buy it and renovate it in a single loan. If you find a property that's zoned right, you can also convert a 1 to a 2 or a 1 to a 3 or 4 if the zoning is right. But we have to have the zoning approved before we get down the road of having issues. Yes?
How are you feeling? Is Salisbury more friendly with that? Or are they still kind of hardcore single family?
I'm a Baltimore guy, so that's a Sean question. I don't know. In Baltimore City, you cannot get a 1 unit changed to a 2 or 3 or 4. One of the first loans I closed in Baltimore City, guy bought a 3 unit We went there, it had 3 meters for gas, it had 3 meters for electricity. The architect drew plans for 3 units. We took them to closing, they went to get their permit. The city said, this is only a 2 unit, I'm sorry. That's a phone call you don't want to get. That's a phone call you don't want to get. So I've learned very early, like check all that stuff out first. But you can do a multi-unit like that if you can find there's not a ton of them out there. On a 2 unit, you would get 75% of the second unit's rent automatically, okay? If you do a 3 or 4 unit, the unit has to have what we call self-sufficiency. And people get caught on this when they don't know what they're doing. So if the building won't carry itself without you making a mortgage payment, they're not going to approve the loan on a 3 or 4 unit. 2 unit doesn't matter, okay? So there's a self-sufficiency test. And again, you guys don't have to know all this stuff. You just have to know to call us and we'll know it. But I don't want people going into it thinking, oh, I'm just going to go buy a 4 unit, it's going to work perfect, because we had a 4 unit in Baltimore that was a 5 unit, and the guy was converting it to a 4 unit so that he could do the FHA loan and live in one. And the appraiser wouldn't give him the rentals that he needed to make it self-sufficient. So he actually called the appraiser and screamed at him. That didn't end very well either. But they do want to make sure those rents cover on a 3 to 4 unit. Okay, does that make sense? Okay. So a lot of people are doing that the ways to get it, because you can get them with 3.5% down. You only need a 620 credit score. We'll normally go to 55 on the back ratio, and we can use the rental, and you can fix the place up and have a nice place to live, and the other person can pay your rent. And then of course, after you do that for a year, then you go find another one and rent that one out, and you can continue to go on and on like that. Okay. In general, a couple things about the renovation loans. We do require you to use a licensed contractor, as I said. The bids have to be itemized. Okay, so when somebody comes in to do the work, we need materials and labor separated for each of the tasks. And the reason is because that's how we pay. So when you want to get a draw on your renovation loan, it doesn't matter where you are in the stage, whatever is completed, we're going to pay you 90% of that. So if half the demo's done, 20% of the electric's done, 6 of the windows are in, then we're going to pay you for 90% of whatever that total package is, and we get that package off the itemized bid the contractor gives, okay? Contractors like that because they can get their money as they need it. We're not holding it up saying, well, only half the windows are in, we're not going to give you all the window money, whatever. So whatever's completed, we can pay for that, okay? Yes?
So a lot of contractors want something up front to get started. Does that work?
Yeah, we'll give, it depends on the job, the type of job. We'll give materials, either part of the materials or most of the materials up front.
Not just a percentage basis.
No, we'll give them some of the money up front, yes. That's the other reason we get the breakdowns. We see what we have in materials. We also check those breakdowns to make sure if it's a $50,000 job, there's not $40,000 worth of demo and then $10,000 for everything else that's left. So we're going to check to make sure that it balances out with the prices for what they're doing, because we can't front load the jobs, okay? All the jobs also have a contingency reserve. So let's say you're doing $50,000 worth of work. We're going to put 10% aside in case something comes up that's unexpected. So if something comes up, you tear a wall out, there's termite damage, we have the money to repair that. If the electric and the water are not on at the time we go there, then we increase that contingency to 15%. So if something comes up like a burst pipe or something, the money is there to take care of that portion of it also. Okay? Yes?
I hate to be like,
No, I want to answer questions.
Is it a part of the original one?
Yes.
85% LTV?
Yes. Yeah, so if you do a $100,000 purchase and 50 in reno, we're going to add the 5 onto it, some other fees, and then you're going to put 15% down on the total, what we call the total package. Okay? And the draw inspections, everything's in the total package, so it's one package for everything. Okay? If you don't use the contingency for something that's terrible or that you don't like, with our approval, you can use the contingency for something you wanted to do but maybe didn't have the funds. So let's say you wanted to put granite tops in, but you bid it with laminate to save money. Well, now you can come back to us and say, hey, we've got this money left. We want to upgrade and do a few things. Maybe add a deck, more expensive appliances, things like that. You could add those things on at the end, okay? If you don't use a contingency, then it reduces the amount you owe. So we're going to do a principal, let's say the contingency is $5,000. We'll do a principal curtailment on your loan. You'll owe $5,000 less, but we don't re-amortize the loan, so you're paying like you still owe the $5,000. But when you come back to refinance and get out of the renovation loan, then at that point, your payoff would be less money. Does that make sense? The the maximum time we like to have to do these renovations is 6 months. If work is progressing, we can get an extension on that. What we don't want, and we do everything in-house, which, did you talk about that?
No.
Okay, I'll talk about that too. So we do everything in-house, but what my draw center doesn't want is you to close on a loan in July, and now it's September and you haven't taken any money, because that means to them nothing's happening. And since we want it done, if you're taking draws and you're getting money, and they're happy to extend it. The other issue we have now is with some of the materials and permits. You know, there's some places where it's taking forever to get permits. Windows were a long lead time for a while. So if you have an issue where you can't get permits, all we need is an explanation of what's going on to extend that period. But we like to have these done in 6 months, okay? You can also finance up to 6 months of payments, so that if the house is not habitable, then we can roll 6 months of payments into your loan, so you wouldn't have to make a payment on your loan while you're making a payment on your rental or whatever it is before you acquire the property. Okay. Yes?
So you're working with local banks. What happens when they go bankrupt?
When local banks go bankrupt? You mean with the properties they own?
I mean, when local banks go bankrupt, like Silicon Valley Bank, what happens to our loans?
Well, so we handle everything ourselves. So I'm going to talk a little about that. So CMG, we're a national lender, and I never even heard of CMG until I started working there, because they came to the East Coast and bought a bunch of people and companies and stuff. So I didn't really know who they were. I've been in the mortgage business for however many years, 98 is till today. And so I didn't even know that CMG existed, but we handle everything from CMG. So we're going to service your mortgage, you make your payments to us. We're going to handle the draws as we go through the draw process. We're approving the contractor. We're doing everything at CMG. So between myself and Sean and our renovation team, we do everything ourselves. I have an amazing assistant. He works 7 days a week. So we do everything ourselves at CMG. So your loan is not going to get sold off. Now, when I say it's not going to get sold off, technically every loan sort of gets sold off because they don't hold it, but we do the servicing on it, meaning we control it. So if you go to refinance, we can transfer your escrow money. We have a really inexpensive refinance program. Did you talk about that?
No, not yet.
Okay.
No.
So yes, we have a really good refinance. So nothing's going to happen to your loan relative to a bank going out of business, because we're handling it. Okay. But when a bank is out of business, you should look to see what they have in their portfolio for houses and go try to buy some of them cheap. Yeah. Okay. The rates on the renovation loans are going to probably be in the mid to high 7s, depending on credit score and amount you're putting down for what we do in-house. And normally there's 1 or 2 points, again, depending on credit score, where it is. And so there's like what we do, then there's the DSCR, and then there's the hard money as far as what you're going to pay for rates. And it really depends on what fits best for what you're doing, your cash flow, how much money you have to put down, how quick you're going to get out of the house, because you have to be careful. There's one guy I was talking to does hard money loans, and if you're not out in 6 months, he starts charging you 2 points a month. So you have to read your documents really carefully, because he wants to be done and get his money back in 6 months. And if you have a delay, you're going to start paying him more. Hard money is a great source to get in and out quick, but it's not a good source if you get a delay in construction. You're going to end up hanging on for a long time, because sometimes that can cost a lot of money. Questions?
Do you have to be an individual doing this, or have to be, or can you be a company doing this?
These are, what I'm talking about right now is all individual loans. Okay. Now I do have a source for the DSCR renovation loan where you can do it in an LLC. Okay. And that's going to be the 20% down. I don't know where his rates are now. I haven't talked to him for a couple weeks, but they'll do that and do a renovation loan in the name of an LLC. Okay. So that's why I was saying whatever sort of you have, we can sort of figure out a box that it fits in to help you with it. The longest delay we have on the renovation loans is typically finding a contractor that will come out and give us a price and call back and send us their information. And, but if it's your first one, it's a great way to do it because you have a lot of protection in making sure what's going to happen. And then typically, most of my customers, their appraisals are higher than what their package is. I don't know what you're seeing right here in this area, but I'm doing one in DC right now. The guy got the house for $250, and he's putting $300 into it plus his contingency. It appraised for $725. and he's converting a 1 unit to a 2 unit. He's going to live in the little unit, so we're getting $3,500 a month rent to help offset his debt because the bigger unit's going to be worth that. So there's some really good deals out there if you can find them. And I know DC is a different market than Baltimore, than Salisbury and the beach and all those things, but there are deals out there still that people are hunting down and finding where it's a great spread because he can come back and refinance, or he can cash out and walk away with 200 grand and go buy another house.
Don't worry about it.
Any questions? Do you want to talk about the refi thing?
I was going to say, I'll hop back in. So
Okay.
right now, it's gotten extended a couple times. So you hear a lot of lenders waiving fees when you go to refinance because we anticipate rates coming down. Everybody does. So right now, if they've extended it to the end of the year, if you purchase a property with us till by December 31st and settle, you have a 5-year window where if you refinance with us, we waive our fees. So that saves you about $1,300 right there, plus we pay for the appraisal. So it's almost $2,000 in savings on your refi costs, for that. Now, the refi has to make sense, right? I know a lot of times with the renovation loans, because the interest rate's a little bit higher than you might get if you were purchasing a home that's ready to go, people will look to refinance back down to the lower rate. Same thing with the DSCR. If you're at a 10 or 11 and all of a sudden now we qualify, what's that look like? We could refinance you, and same thing, we can waive those fees, for that. So you're seeing a lot of lenders offer that right now based on the anticipation that rates are going to come down, but a lot of them are giving you only a year to refinance. What do rates do in a year? We don't know. Like I said, it's projection. So we're 95% sure rates are going to settle down, but then again, that could be a little variable, as well. But bottom line, there's opportunity out there. We're here to help you and sit down and really strategize with you. That's what I like to do. Is if you want, we can talk over the phone. We can sit down. Alex is coming into the office. We can sit down and just talk about what your plan is. And what outlets do we have for you, and then kind of both research on our side, and then go back to it. If you're a new investor, we've done that too. With one of Bonnie's clients, that we sat down and just kind of he was getting into the game. And he's like, what do I do? What options are there? And we kind of just sat down for an hour and just tossed around different ideas. And that's kind of where we get creative with you on that. And if it's not an option, like Lewis said, and we don't have something that we think, we usually have an outlet where we can send you that possibly can take a look at it, for you as well, for that. But does anybody have any questions at all?
I had one question that actually somebody else asked on our Facebook group. So some people buying some of the LLCs, for example.
Mm-hmm.
They holding LLCs and they're buying with the LLC because of more protection. I'm not sure how there's a hard money with LLC.
Yeah.
When they're going to refi, they will have to change the whole ownership. If
Yeah.
you're going to traditional with a 30-year mortgage. That's correct?
That's correct. So if it's already in your personal name, we can refinance in your personal name. If you've converted it to an LLC and then you want us to refinance it, we're going to have to pull it out of the LLC and title everything back in your personal name again. Now the rule, what's that? Correct. Correct. Yep. Yeah. The rule is that technically you're supposed to call the lender to get approval to transfer that property to an LLC. Whether people do that or not, I'll leave that up to you on that. What's that? Yeah.
Yeah, they technically could call your loan if they found you put in an LLC, but they never do if you're making your payments.
Correct.
But the other thing too is a single member LLC doesn't give you a ton of protection, and a lot of LLC loans want you to guarantee it till they have experience with you. So a lot of them are going to be like, well, you're personally guaranteed anyway, so the LLC is not doing you. And I'm not an attorney. I'm not giving this guy is. I'm not giving you advice on it, but if you may want to get through. If you're going to do a reno, it makes more sense to put it in your name, renovate it, refinance it, then put it in the LLC for the protection at that point. Because you don't need as much protection when you're under construction, because you don't have tenants and people walking and falling, all those kinds of things. And then the other thing that I thought about while Sean was talking is the huge benefit I see, and I've been doing renovation loans strictly for the past 10 years, is that you're starting with equity. And so many times people will call me, whether it's a homeowner or an investor, and they'll say, oh, I found this house on Elm Street and it's 100 and I think it needs 50 in repairs. And I'm like, well, what's everything on Elm Street selling for? And you know what they say? I don't know. I'm like, well, wait a minute. How do you know if it's a good deal? Because if every house on Elm Street sells for 125, that doesn't sound like a good deal. And if every house I know for you sells for $250, it does sound like a good deal. So I know some of you have experience and your ages, all those kind of things, but it's so funny to me how many people are all excited, but they don't know what the after improved value is going to be. And one of the most, this is a saying I stole from Alex. You don't make money when you sell the house. You make money when you buy the house. So when you're purchasing the property, that's when you're going to make. Everybody thinks, oh, I'll get my money when I sell it. No, you make your money when you buy it, because if you buy it right and renovate it right, then you're sure you're going to make money. So always know what the neighborhood and the area is selling for, unless you want to break even. I wouldn't do an investment to break even. I'd want to have some equity. And that's the other reason people come back to refinance, is because that additional equity either eliminates the mortgage insurance or reduces it drastically, because you put the sweat equity and done all the work to make more money.
That's correct. Yep. Well, if there's no questions, thank you all for having us.
Thank you. Appreciate it.
We'll leave some cards for you.
Yeah, I got
Any
some
questions,
cards
let us
also.
know.
So as far as the process, what if anybody new, I highly recommend to talk to your lender. Like I usually do it first time I did it was I waited for 3 months before, and we talked about what is the game plan to do it, and after that you can actually you can buy the property, see how much your payment's going to be, and what's your interest rate. And with Sean, I spoke with him I think in January. We bought the property in March. And from then we just did a few, 4 deals I think now. Yeah. I haven't used the construction loan. Is it 2 or 3? That's what it is, or different thing?
2 or 3K is if you want to buy a multi-unit and live in one.
Okay.
But then there's home style, which is a renovation.
It's totally different.
2
Okay.
is primary. It's got to be primary. That's
Okay.
FHA.
So that's great. I didn't. I was gonna think, what is it? It's the same one. Okay. So I know 2 or 3 is really painful to do.
No.
No. I heard
It
a
got
terror story. Okay.
Good.
Okay.
Talking to the wrong people.
Okay. So good. I'm happy to hear that. All right, cool. So just stay here and ask questions, connect with people, and I will post the video here, and then contact is right here. Just, yeah.
Thank you. Appreciate it.
Thank you very much, guys. Appreciate it. Have a good day.
Thank you.